It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, national underwriter for Old Capital. And joining me today, smartest guy in the room, Michael Becker.
Hey, Paul.
Michael, who owns over, it closed 5,200, 5,300?
5,200 plus doors, yeah.
That's incredible. You know, the former banker now has gone from being a loaner to being an owner. We call him affectionately the mayor of Beckerville. So thanks for joining us, Michael.
Oh, thanks for having me, Paul.
So I don't want to forget before it gets too late, we do have the speaker series coming up. We have a speaker coming in on February 15th. Tell us a little bit about that, Michael.
Yeah, so the next one we're going to have, we have two coming up here, but the most recently, it'll be pretty quick after this airs originally. We're going to have David Kahn from CoStar. He's an economist from CoStar talking about kind of the state of the apartment market, the economics, as well as we're going to have Mark Patton, who's actually the accountant that both Paul and I personally use. He's going to come out and give a little bit of an update to the Tax Reform Act and kind of talk about some of the applications, how that applies to commercial real estate investors like all of us that listen to the podcast. So that's going to be on February the 15th. Doors open at 6, so we'll have about an hour worth of networking, and then the presentations will start at 7, go for about an hour or so. And then we typically have a little happy hour afterwards, too, if anyone that wants to partake in that. And then following that, if you listen to this after February 15th, the next one will be on March 28th. We're going to have our annual visit from Dr. Mark Dotzauer, the former chief economist for Texas A&M's Real Estate Center, and he's a really great speaker. If anyone's never had the pleasure of hearing Dr. Dotzauer speak, I would certainly put that on your calendar. And like we referenced before, the first couple times I saw Dr. Dotzauer speak, it cost me over $100 of a ticket to come out and hear him speak. So Paul is being generous enough to subsidize Dr. Dotzauer's trip here. So we expect to have over 400 people. So I would certainly encourage you to come out and take Paul People's generosity to heart and hear Dr. Dotzauer speak on March 28th, also at the Grapevine Convention Center near DFW Airport.
More than happy to share Dr. Dotzauer with everybody, just a great economist, and everybody who's an investor listens to him. Whether you're a banker or you're an investor or a builder or developer, he is the guy that everybody listens to.
Yeah, and also more than the content, we always beat the drum. This is that no one's going to come to your house and give you money or give you deals. If you come to both of these events and the networking, there's going to be multiple power brokers that sell, hundreds and hundreds of millions of dollars worth of apartments a year in that room, as well as many, many other apartment investors, both active and passive. So if you don't know where to find deals or find money, this would be a place where they both will be in the room.
So the question that came in for Ask Mike Monday is, Mike, what's going on with all these interest rates? Should we be concerned?
So I am certainly not an economist, and I only have a layman's understanding of why stuff happens. But recently we record this, the 6th of February, I think is today's date, as we record this podcast. And over the last, really since about November, the rates were down the low 2s, about 210, and we're about 280, give or take, as I record this. So we've had about 70 basis points of movement in interest rates over the last 3 months or so. So that's doesn't seem like that much, but on a percentage basis, that's quite a bit, 30% or so of the rates. So it seems like, from my understanding, that we have everyone in the marketplace is fearing some inflation that is coming, and the Feds keeps tightening the short-term rates, which are causing some of the longer-term rates to go up as well. So that seems what's going on. Some of the things that is kind of a repercussion of how that affects stuff is when we're going out, especially getting agency debt, so Fannie Mae and Freddie Mac, which is what most people want. The pricing of those loans are based off the 10-year Treasury plus the spread. So as the index, the 10-year Treasury has gone up 70 basis points in the last 3 months, it makes your overall rate go up. So it's causing, I'm sure Paul can expound upon this a little bit, but it's causing some sizing issues on your loans, because all your loans have to have a 1.25 debt coverage ratio, like we've talked about many times. So if your debt service goes up, then, and your NOI stays the same, then they have to cut back your loan proceeds.
Yeah, think of it as kind of like a teeter-totter on a kid's playground. And the fulcrum in the center is that 1.25 debt coverage, and that you must have that. You have to have enough income to pay for your debt service. So you got to have enough NOI to pay for your debt service on the property. So on one side, you have interest rates. The other side, you have loan dollars. So if you start taking the interest rates and moving them up, your loan dollars are going to get caught, because now they're going to get cut, because interest rates, when they go up, loan dollars go down. Be very careful about when you get into these deals. If we first were thinking about trying to size transactions with a 475. Now I'm trying to give guidance that size them at 5.25%, because you typically do not lock these loans until the loan has a commitment back from Fannie Mae, which may be 45 to 60 days from the point you put your application in. So that's after you've done all your negotiation and the offer's been accepted. You've put the money in to do your third parties. Now from 45, 60 days, that's where all things happen. And now when you get the commitment, that's when you typically lock, and usually takes 5, 6 days then to close. So if you had priced it at 475 and you got your max dollars at 475, and now interest rates have gone up to 5.25%, your loan dollars are going to get cut. So you got to bring more money to close that transaction. So just be observant, be more conservative right now than being more liberal when it comes to interest rates and sizing deals and making sure everybody doesn't panic right at the end.
Yeah, the other thing I think I would want to encourage, so this is something that we just recently encountered. So I purchased a property about 2 years ago, and we assumed a mortgage with about 4 years left on it and put quite a bit down. So we were able to come in about 2 years into it. We implemented our business plan, increased the NOI, and the value's gone up. So we just ended up refinancing the property. So we actually ended up going with the Freddie Mac loan, with the Freddie Mac Green program. So it was a pretty great term. We got 10-year term, 5 years of IO. But one of the cool things that we were able to do is we did what was called like an index lock. So basically that we're back in November, we were able to index lock when the 10-year treasury was about 2.3. So we saved, over 40 basis points from where it was when we actually closed on the loan. So if you guys have the ability to, that's one way to hedge some of this risk, is if you can come in an early index lock a Freddie Mac loan, or even Fannie now, which is relatively recent, has a streamlined rate lock available. So you have to clear some hurdles. And I don't want to get too much in the weeds on it, but certainly if you guys have the means and you're confident in your deal and you can get it done and you have the capital, set aside, you could go in an early index lock a Freddie or early index lock or streamlined rate lock a Fannie loan. I would certainly encourage you, if you guys have some questions, just pick up the phone and call, Paul or James or Ricardo or Jonathan, one of the old capital guys, and they could certainly go through a lot of the nuances of that.
Yeah, that's absolutely true. So that's one of the ways that you can get not around interest rate rising, but it's one of the ways that you can work through it, is try to rate lock the transaction early in the transaction. Just like Michael says, there is a couple things that have to be done, and you're going to put some money at risk.
2% of your loan amount. So this isn't you got to be sure you're in this deal before you do that.
Yeah, you want to make sure that you are all in, because you're going to take 2%, which would typically be non-refundable. But if something happens in the transaction and you've rate locked that deal, you've pushed away 2% of the loan amount.
Yeah, so again, $20 million loan is $400,000. So you need to make sure you're in the deal.
Yeah, you got to make sure you're all in. So. Anything else going on with that?
So this kind of general musings about what's going on in the marketplace due to the rise of the interest rates. One of the things that I've always taken the stance that we're going to do long-term fixed rate debt. And so for the last, 5 years, I've been absolutely wrong in my decision, where we would have been more advantageous to take some floaters and have open prepayment penalties, because the long-term fixed rate debts all come with either defeasance or yield maintenance prepayment penalties, which are, fancy ways of saying very, very large prepayment penalties, essentially. So we've been having to sell some properties and have loans assumed when we sell them. But that seems to be, with the rising rates, it seems to be maybe turning to where having long-term fixed rate debt be more advantageous. So you can offer a loan assumption at, a rate in the low 4s. And if current market rates spike in the mid 5s, and we'll have, a full percentage point or more lower on the rate they can assume. So it should be accretive to the situation. So that's one thing that last year, after the rates rose right after the election, one of the things that we made a big push at SPI was to do loan assumptions. So we bought 5 deals, and the last 4 of them were all loan assumptions. So, we're to the point where I feel that the loan assumptions have been a little bit more attractive for a while, because you tend to get a little lower purchase price, so you get a little break in your cost basis. And then any more like what Paul was just talking about on the front of the deal, these deals are getting debt service constrained even on new debt. So, you're not getting a lot of these, especially the nicer quality deals, you're not getting 80% leverage anyways. So if you're going to be debt service constrained at 75% or 73%, then the loan assumption makes more sense. The only thing that you really give up is having that extra term on the back end, and you typically give up some interest only on the front end of the deals, where the new debt you can get, any more now, 3 to 5 years of interest only pretty regularly. On the loan assumptions, most of these deals are already amortizing. So Paul, anything to add to that?
Nothing really, but if somebody wanted to find out a little bit more about what you do, Michael, when you are investing in apartments, who do they have to talk to there?
Yeah, the best way to find out more information about my company, which is just to go to our website, which is www.spiadvisory.com. That's SPI like spy advisory.com. And on there, we have a contact us page, and certainly always happy to have a 15-minute or so telephone conversations with listeners of the podcast if you want to find out about more information about what we do. But so we definitely appreciate everyone listening to the podcast. Definitely want to encourage everyone to come out on February 15th and March 28th to the Grapevine Convention Center, listen to the Old Capital Speaker Series. You can find more information. You can sign up and register for these events at www.oldcapitalpodcast.com. On there has all the particulars, and we certainly ask that you come and sign up and get a ticket for the events.
Great information. Again, smartest guy in the room, Michael Becker. I'm Paul Peebles. Have a great day.